When you talk about gold, Joe, you're absolutely right. On a 3-year move, up 150%. But what has been the impetus? Obviously, there's geopolitical tension. There's people focused on decoupling from the U.S. dollar. But it's also a lot of central bankers got caught off sides during COVID from that inflation hedge. So we have seen 3 consecutive years of record accumulation from central bankers. And I think moving forward with the relative strength at an all-time high in gold futures at an all-time high today, we're still going higher. $5,000 is a target, but I don't really see a ceiling short term.
Gold has been on a historic rise in the last couple of years, and especially 2025, where we just saw a broad-based rally, not just gold, but based rally in silver, platinum, copper, and so forth. So there's a big opportunity in the metals market that we have seen so far in 2025. Now, if we take a look at the rise, and I mean, you can see where one has been leading the other, but overall, as a sector, as just the metals, we have seen an epic rally. So this is again where, as a trader, we try to see how we can take advantage of these moves on the top of exactly what we're doing in options market, forex market. Futures is a great way to capture that big move. So in this presentation, we'll go over the metal futures. We'll talk about the aspects of metal futures, take a look at contract specification, trading tips, market insights. So let's get into it. And remember, the reason why we really like futures is that it allows you to trade 23 hours a day, again, giving us a bigger window on capturing those movements. So let's start with gold futures. And in futures in general, all you really need to know is what's the margin requirement and what's the tick value. And for one standard contract of gold futures is $10. So the math is pretty easy. As you look at 100 ticks, 100 points on a move, then multiply that by 10, that's about $10,000. So really, that's how you can gauge your P&L based on the amount of move that you're looking into on products. Same thing goes with silver. The tick value for that is about $25. And based on how much silver moves in a day, and you can do that tick times the tick value, that will give you the exact P&L that you can have on a day-to-day basis. And similar concept for copper futures, we have the maintenance margin there and the initial margin, but we're looking at the tick value for $12.50. So based on the value, based on the movement that you get on a day-to-day basis, multiply that with that $12.50, and that goes your movement for the day in P&L. And lastly, platinum futures, same concept. Now, tick value for that is about $5, and the margin requirement you can see is a bit less. So you'll notice that as the margin requirements for each product could vary, and the tick value for those each product could vary, but you really have to take a look at a percentage move to really capture the P&L on that move. Now, one of the most commonly asked questions I get is the size of the futures is pretty big. The margin requirements, the P&L, everything is on a full-size contract is pretty high. Now, that's not feasible for traders with a smaller portfolio, retail traders. So this is where the good news is that there's also a micro future available, which is just the same contract, but on a smaller version. So it's scaled down to be more accessible for retail traders, small portfolios, and testing the strategy with less risk. So the micro future is 1/10 of a value for one standard contract. And remember, the mechanism, everything else exactly the same. It's just the size of the contract is scaled down. So for a regular full-size contract for gold is GC. So if you go on your trading view, you can just type in GC. The first option will come is gold futures. Now, let me show you a quick tip on how to quickly calculate the tick size. So this is where the bar replay feature comes in very handy. So let's just go back in time. Let's just go practice a little bit here. And as a simulator trade, let's just say you want to put on a one standard contract. You click on a buy. Right over here, it actually tells you the tick value. So for one every point is about $10. Now, when you look at a micro feature, which is the MGC, so you're just really adding an M in the front, there's an MGC. So you click on that, and right here, let's just do the exact same thing, click buy, and what you notice is that tick value is $1, which is 1/10 of a value. Remember, it's about the controlling the risk, and with that one, it's more feasible. So let's just put a hypothetical trade on. Let's just buy one single contract on that one. Remember, the math is pretty simple. Let's just say if I'm buying it at 134, let's say I'm buying it at 3,500 and my stop loss is at 134.75. So I'm really risking 25 pips, 25 ticks, 25 times by, that's an easy way to do the quick math. Now, when you, let's just say, even a small contract size lag, you can see that it's still a pretty big value because, again, the way the gold has been moving, percentage-wise, is a lot of intraday movement. So I know one of the things I always get is that, hey, maybe that contract size is too small, but again, it's still a good size contract with a lot less minimum margin requirement, but also the tick value for that is lower as well. So which it really allows traders to manage risk a lot better with a smaller amount rather than going with a full size contract. And now with those numbers are also the 1/10 instead of 1/10 being a full number as well. So that would be a bigger game. This is much more feasible for a lot of traders to handle. And remember, a lot of the futures traders, this is you're doing that on the top of your other trading strategies, other instruments like options market, trading in the stock market, trading the currency market. Now, futures is just another good way to add on to the exposure. Also doing hedging as well, especially after hours, when the equity markets are closed, but then the futures market are open. Remember, this is a 23 hours a day, 5 days a week operation. It's only not available between 5 p.m. to 6 p.m. That's really the only time it's offline. But if you really go back in, time, and you'll notice that the moves are happening, not just in the US hour, but it's also happening pretty much around the clock. So it gives you an opportunity to take advantage of this as these moves are evolving overnight into the U.S. session. So all the mechanisms stay the same, charting remains the same. All you really have to do is understand the risk and the setup you're trading, the timeline that you're trading, and it's a great way to start having exposure to these metals market, which has been very lucrative, especially going into this year. Especially, there's a broad-based rally. So TradingView is a great tool to practice that. Like I said, go back to the bar replay feature. You can actually literally go back in time and say, well, how would I have done this in this scenario? What if I had done with a standard contract? And you can see that there's always setups. We always try to trade the setups. As you can see, there's a lot of times you can get some good setup with good risk amount, and there's definitely things that are happening that you can take advantage of pretty much on this move. And so far, as you can see, the gold move has been phenomenal, and then we are continuing to see that run. This is, again, gives a great opportunity both on the long side and the short side. Let's say gold tops out and start to reverse that trend. We can also take advantage of that move by shorting that contract as well. So go ahead, trade it on, practice it on your simulator account before you're comfortable putting in your live account. Thanks for watching. See you in the next one.